And away we head. It's that time of the week we talk a little politics, a lot of financial stuff. Zach Abraham, Chief Investment Officer, Bulwark Capital. Friend of the show, sponsor of the show. All right, brother. War has been avoided, and that's a good thing for the economy, I think. I guess it depends, unless, of course, war economy is good, but we're so upside down, that's not good for us.
Peace in our time, man. Peace in our time. So we were just talking about this today. The economy is throwing off all kinds of mixed signals. When you consider the things that are on deck, it shouldn't be surprising. I don't know if I've ever seen a period of time where you have this many cross signals and people will go, well, COVID was crazy. It was, but it was very binary, right? It was economy's been shut down. They're printing boatloads of money. Is that going to work? You know what I mean? It was a fairly simple binary 1 or 0 outcome. When you look at the world today and you look at it geopolitically, what's going on, you think about the impact it has on commodity prices. When you look at the dollar now really testing downside support, at the same time, the U.S. housing market is not in good shape. And that touches a lot of different parts of the economy. It still does. It's not as big a part of the economy as it would have been 25 years ago. But, like I tell people, think about the parts of the economy that get touched when you build a new house, right? Like everything, right?
Yeah.
Copper,
you buy a
concrete.
new house, you want to get new appliances. You buy a new house, but the house is built with all kinds of stuff, manufactured businesses. I mean, it is the most important purchase, and it's also the thing that when you buy it, is going to have the most impact on the economy inch by inch.
Yep. And so then you see what really looks like some pressure on consumer spending. You see more and more loans coming out of deferment, which is going to be a further drain and a further stress on consumers. And that being said, though, flip around and, the big, beautiful bill boosts government spending by another $500 billion, right? So you look at all these different cross currents. Now, to be fair, it's not entirely fair to say it boosts it by $500 billion because you do have to offset that with tariff revenue, right? But remember, tariff revenue is going to be offset by higher prices as well. So we'll have to see what that number is. But bottom line is government spending is going higher, right? And, when you're running deficits, Chad, of 7-8%, the entire size of the economy, it makes it harder for that economy to go into recession.
Yeah.
And people go, well, what are you talking about, Zach? And I go, well, remember, government spending virtually, and especially for us these days, and this will be the same, it doesn't go down in recessions. It typically goes up, right? So when you start thinking about being at 7 or 8% of the deficit, that is spending that is not going to be impacted regardless of the economic outcome, right? And so then you think about historically normal levels of deficits, let's call it 2 to 3%. So you've got more than double the amount of let's call it government stimulus than you would normally have. And what that means is you have an economy that's less vulnerable to tipping into recession. And now, does that mean that bad things can't economically happen? No, but it opens up, I think the avenue that it really opens up is the potential for stagflation, right? Where maybe you've got GDP growing, but you've got inflation nullifying a good amount of that.
Wages, all of that. It's like being stuck in quicksand running uphill. I worry. I would rather have a recession and then get our footing and take off than be Japan of the 80s and 90s where you're in stagflation hell.
Yeah. And I very much agree with you. The number of cross currents out there is stunning. The other thing that I think is something that you've got to keep an eye on is I very much believe that is this administration's policy to get the value of the dollar down while keeping a lid on oil. Okay. And all of this, man, all of this point, look, these things are not going to be bad. If that, let's say you avoid a recession that is serious in any way, shape, or form, right? Maybe you have a nominal recession, But I mean, let's say you have a quote unquote technical balance sheet recession, right? Where you get a reduction in GDP for 2 quarters in a row. And let's say the unemployment rate doesn't go above 5.5. With that level of government spending, it is entirely possible you have a recession that doesn't even really feel like one, right? Because that government spending level is just so large.
Yeah.
But I think it is the stated object of this administration to get the value of the dollar down significantly. A lot of people think that level is between 88, 86 on the DXY, the dollar index. The reason I bring that up is because what is the thing I've been talking to you about? Saying that, look, I think there's plenty of companies in the United States that will continue to do well. And I think if you hunt for value, you can find it out there. The problem is that's not how everybody's invested. Everybody's loaded up on the Meg 7 stocks at the top. Everybody's loaded into the triple Qs and SPY. And I just think that game is over. And the reason I think that game is over is based on A, valuations, right? B, looking at how long U.S. markets have rallied with virtually no other significant markets in the world keeping up with them. But all of these things that we are describing, a DXY at 86 to 88, right? Dollar down, avoiding a serious recession. Then you look at the valuation spreads around the world. Like I was telling you, we're up between 16 and 17% on the year right now. Market's up 3%. There's really no clever thing we've been doing other than buying really cheap, good companies overseas, picking up some here in the United States. But man, these opportunities just abound if you're looking outside the United States in the unloved sectors. And if they are trying to get the dollar down, which everything they're doing suggests that's the case, if they can keep a cap on oil, if you're talking about in this world right now, a DXY between 86 and 88 and oil between 60 to 70, Katie, bar the door, emerging markets are going to go ballistic. And then you go into those markets and look what these assets are valued at. Again, people are all caught up. Is the U.S. breaking out? Is it? My answer, I don't care. I don't care. I'm looking at all this other stuff, and people are like, well, Zach, even our clients saying, well, Zach, should we pull back on some of that stuff? We've already had a great part to the. And I look at them and I go, guys, when you look at what's going on economically, we've got a lot of stocks that are up 40, 50, 60% on the year. They're cheaper than when they started the year. When you look at their earnings trajectories and the underlying fundamentals. So, I think that if people stay in these U.S. concentrated Meg 7 portfolios, it's going to be a disappointment. I'm not pretending or I'm not forecasting pain or an absolute collapse or anything of that way, shape, or form. I just think as great as the U.S. trade has been for the last 15 years, I think it's going in reverse. And then you look at the valuation spreads, you look at the trajectory of the dollar, you look at all these things. The setup for emerging markets and international stocks is as good as it was coming out of 0809. It's better, actually.
Board Capital. So you look at all that stuff. It's funny because I talk to a lot of people about, because again, you and I have always talked. A lot of people have no idea that there's other markets you can invest in. They think the stock market is the stock market. That's it. Everybody, nowhere else to do it. They've heard of maybe the UK had one, I think, or Japan has one, but they have no idea. Emerging markets are everywhere. Opportunities are everywhere. And it always fascinates me that people, because they're in positions that their guy that they talk to once every 6 months or a year, who cookie cutters him into stuff. We got you some Apple, we got you some of this and some of that, and this will be good. Just ride it out, it'll be fine. And that's because it's just easy to cookie cut.
Yeah, it is. And look, to be fair, the United States is the best place to have capital, okay? So you look at the depth of our markets, the fact that we have the world reserve currency, we have the most developed regulatory bodies. It's the best place to have capital. So U.S. markets deserve a premium, but they don't deserve the premium they're trading at. And it just comes down to fundamentals, right? You look on one side of the corner, and they're trying to sell you a $10 bill for $25. You look at the other street corner, and they'll sell you a $10 bill for 75 cents. Right. Yeah. So it really is that simple. The real concern, like I was saying, people are like, well, you don't think U.S. markets are going to collapse? For a variety of different reasons, I don't think they're going to collapse. But here's the thing. You know what it feels like to get, let's say, 2 or 3% annualized growth in an environment where inflation's running at 5 to 6?
Feels like a loss.
It is. You're looking at a loss over a 10-year period of time that's right alongside 40 to 50%. So, and when you look at the historical value, you're in a really interesting spot right now because, people are always like, well, the timing is hard. Timing these things is hard, but very rarely do you get opportunities like this where the valuation spreads between international stocks in the United States or any market for that matter they've never been further apart, ever. So, unless your thesis is there will only be one market and it's like the Highlander, right? There can only be one. It's probably a pretty good time. And like I said, you don't have to wholesale it. I was telling you about Nike. We bought Nike about a month ago. We thought it was too beat down and got a good earnings report today. We're up 11% in after hours. There are places, but so much of these valuations and so much of these prices have gotten so ridiculous. You really have to sift through U.S. markets and make sure things are priced in a way that makes sense. And I'll give you an example of something that doesn't make sense. Microsoft is one of the most incredible companies to ever operate. You're now talking about a $3.6 trillion company trading at 13 times revenue. So, and I don't think people, I know for a fact the average investor doesn't realize how insane that is. There was a guy by the name, I believe it was Scott McNeely, who was the CEO of Sun Microsystems. Remember Sun Microsystems was one of the big go-go tech bubble ones, right? He gave an interview around like 2003, 2004 after the price of their stock collapsed. And everybody's like, what went wrong? And he goes, what are you talking about? They're like, well, the stock collapsed. And he goes, listen. He goes, Sun Microsystems is doing fine. He said, but when investors bid your stock up and his mile marker was 10x. When they bid your stock up to 10x revenue, he's like, that's absurd. It's not our fault that they bid the stock to that level. Yeah. He's like, what that's assuming is that for the next 10 years, you're going to have no overhead costs, right? You're not going to have to pay any taxes. You don't have to pay any labor expense. And he just sat there like on an accounting basis and was like, it's ridiculous. Unless you've got a company that's growing at 80% a year in terms of revenue growth, that valuation is going to be a disaster. Well, Sun Microsystems was not the number one stock in the S&P 500 by market cap weighting back then, right? That was an also-ran. That was at the bottom of the NASDAQ. Now you've got Microsoft trading at 13 times revenue. Great company, but not interested. When you see these other valuations out there around the world, it's on the flip side of that, we just this week purchased a Latin American bank that's been around forever, sterling reputation, great board of directors, stock trades on the New York Stock Exchange. Thing is growing at double digits, got a fortress balance sheet, and it's paying a 14% annual dividend and trading at 4 times earnings.
That's a win.
Yeah. I mean, it's hard to lose. When you buy a stock like that, truthfully, unless there is some kind of fraud involved, it's almost
it's
impossible to
be
lose.
As bulletproof as possible.
100%. Yes.
Just
100%
bulletproof. Something can happen, but the odds of it are much slimmer than buying something trading at 13.
Oh, well, yeah. So the way I look at it, chat, if you had a portfolio full of those things, right? If you had a portfolio full of stocks that fit that deal, that portfolio is going to kill it. You'll have a couple positions in there that don't play out, but if you buy a portfolio of companies that are growing double digits that have fortress balance sheets, and you're paying 4 to 5 times earnings and you're getting double-digit dividend returns, that portfolio is going to win.
Amen. Zach Abraham, Chief Investment Officer, Bulwark Capital. People want to reach out to you. They want to talk to you. Want to get a second opinion. What do they do?
BulwarkCapitalManagement.com, or you can Google our podcast, Know Your Risk Podcast. You can find us on YouTube, all the different social media channels. We do our daily broadcast that's usually 25 to 35 minutes, total summation of everything that went on important that day in the world of finance and economics and government and politics. And great place to get a summary. We're also active money managers. So like I say, reach out, BulwarkCapitalManagement.com. We're not hard to find.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. Information presented is for educational purposes only. It should not be considered specific investment advice, does not take into consideration your specific situation, and does not intend to make an offer or solicitation for the sale or purchase of any securities or investment strategies. Investments involve risk and are not guaranteed, and past performance is no guarantee of future results. For specific tax advice on strategy, consult with a qualified tax professional before implementing any strategy discussed herein.